Hello, everyone, and welcome to another edition of Modified Gough Square Live. This week, me, Tom Samuels, and Sabrina Goodchild are coming to you in the form of a podcast. Now, if in between pondering what really happened to Carol Baskin's husband, you keep an eye on FCA developments, or indeed have subscribed to the FCA's daily coronavirus news and publications alert, you cannot help but have noticed the sheer volume of new publications resulting from the coronavirus pandemic. The publications deal with issues from the UK Coronavirus Business Interruption Loan Scheme to extended deadlines to publish fund reports and accounts. In amongst these publications are two sets of temporary guidance documents that deal with consumer finance in the context of COVID-19. It's on these documents that this talk focuses. We'll consider why they're needed, what provisions they make, and the potential issues they create. We had originally intended to start this podcast with a discussion of why the FCA had felt the existing forbearance provisions were inadequate, so as to require additional specific coronavirus guidance. However, it's clear that in fact the FCA is not of this view. The purpose of the temporary measures is to add to rather than replace firms' day-to-day obligations under the handbook. To provide a quick timeline of how matters have proceeded since the start of April, the FCA initially published draft guidance on the 2nd. It related specifically to loans, overdrafts, and credit cards. Given the rapidly changing public health situation, the FCA heavily curtailed the usual statutory process for consultation, relying upon Section 138L of the Financial Services and Markets Act 2000, which provides the ability to do so in order to avoid prejudicing the interests of consumers. Limited consultation was undertaken in relation to the draft guidance on loans, overdrafts, and credit cards, with the responses requested by the 6th of April. However, there was no formal consultation in relation to the other products. Rather, the regulator invited comments from certain firms, trade bodies, consumer groups, and individuals. Thereafter, the finalised guidance on loans, overdrafts, and credit cards was published on the 9th of April, coming into force from the 14th. The other guidance we're going to review, which relates to high-cost short-term credit, motor finance, and so-called rent-to-own products, followed on the 24th of April and came into force on Monday the 27th. It bears repeating that none of the coronavirus guidance is intended to replace existing rules or guidance usually found within CONC. The FCA has been clear that firms should continue to comply with their forbearance obligations, particularly in relation to suspension, reduction, waiver, and cancellation of interest and charges. So in that regard, CONC 7.3, which is treatment of customers in default or arrears, and CONC 7.7, the application of interest and charges, remain of central importance. Instead, the temporary guidance builds on the FCA's general expectation that firms should provide, quote-unquote, exceptional and immediate support to their customers during these times. Its intention in intervening in this fashion was to build on Principle 6, which requires firms to treat customers fairly. The overarching obligation is already referred to in CONC 7, e.g. at 7.3.2 and 7.7.1. As such, the coronavirus guidance simply sets out the FCA's view on how that Principle 6 and the handbook provisions which refer to it should be applied for the time being. It's also worth underlining that all of the guidance we're going to consider relates only to issues which specifically arise from the coronavirus. Therefore, if a customer has payment difficulties for some other reason, the guidance will not apply. That said, it may not be straightforward for firms to determine the root of an issue. For example, if a customer notifies the firm simply that they've been made redundant or have suffered bereavement. Since the FCA has stated that compliance with the guidance may form the basis for later enforcement action, discretion is likely to be the better part of valour. That being so, a tactful follow-up inquiry may be appropriate. Alternatively, if not appropriate to do so, firms would be well advised to assume that the new guidance applies.
So, as Tom mentioned, the first group of temporary guidance documents that we're going to talk about have been implemented to support users of personal loans, credit cards, and overdrafts. The key provision to highlight in relation to credit cards and personal loans, but not overdrafts, is the creation of payment deferrals. A payment deferral is defined as an arrangement whereby a customer is permitted to make no payments or a token payment not exceeding £1 where a firm's systems will not allow for a £0 payment under the agreement without being considered to be in arrears. The guidance provides where a customer is already experiencing or reasonably expects to experience temporary payment difficulties, and wishes to receive a payment deferral, the firm should grant a payment deferral for 3 months, unless it is obviously not in the customer's interest to do so. Such a request by the customer can be made at any point after the guidance came into force for a period of 3 months, i.e. up until the 14th of July 2020. Given the payment deferral, if granted, lasts for 3 months, firms are likely to be dealing with payment deferrals until the 14th of October 2020. As to when it is not in the customer's interest to grant a 3-month deferral, relevant considerations include the ability of the customer to repay accrued interest, which may still be charged during the payment deferral period, and over what period. Relevant to those considerations is, of course, the interest rate, and in the case of personal loans, the remaining term. If a firm determines that a 3-month deferral is not appropriate, they should, without unreasonable delay, offer other ways to provide temporary relief in accordance with Principle 6. For example, by offering reduced payments, a shorter payment deferral of less than 3 months, or a rescheduled term for personal loans. Finally, in this regard, and just to note, the guidance contains further provisions dealing with the communication of the availability of payment deferrals to customers to ensure they know about them, charges and fees which can't be charged, adequate information and credit reporting. Now, what further provisions are made in relation to credit cards? Well, the principal further provision deals with the prices set for credit cards. Firms are instructed to review their prices to consider whether they are consistent with Principle 6 in light of the exceptional circumstances arising out of COVID-19. Finally, in relation to credit cards, and just to note, further provisions are made in relation to the suspension of credit facilities, safeguards to help customers at the end of a payment deferral in the event of a sudden increase in their minimum payments, indulgences and waivers, and the contractual minimum repayment amount. For further detail on those measures, do have a look at the guidance. So what provisions are made in relation to overdrafts? Well, 2 key provisions are made. Firstly, it provides for interest-free overdrafts, and secondly, it deals with overdraft interest pricing. So looking first at interest-free overdrafts, the guidance provides where a firm provides an arranged overdraft and a customer has difficulty or is reasonably expected to have difficulty with finances due to the impact of coronavirus, at a customer's request within 3 months of the guidance coming into force, the firm should, 1, where the arranged overdraft limit is up to and including £500, provide the overdraft interest-free, and 2, where the arranged overdraft limit is above £500, provide the first £500 interest-free, and then apply the standard pricing rate for borrowing above the £500. Now, customers can, of course, apply for new or increased overdraft facilities in the usual manner, but the creditworthiness assessments can look beyond a customer's current circumstances and may take into account historic information. In relation to new or increased overdrafts, the guidance provides 1, where the arranged overdraft limit is increased to a limit below £500, again, the overdraft is provided interest-free, and for new overdrafts, the same provisions apply. The first £500 will be interest-free, and then the standard pricing rate for borrowing above £500 is applied. And this assistance is to last for 3 months from requested. The second measure, which is enforced for at least a 3-month period, is a response to the recent increases in arranged overdraft prices following the changes to the unarranged overdraft regime in 2019-2020. These measures provide that firms must review their prices to ensure that they are at a level consistent with their obligation to treat customers fairly in the light of the exceptional circumstances. This involves ensuring that customers are not worse off compared to the old prices pre the increase. And finally, I just flag that provision is made for the amendment of the overdraft for repeat use strategies, so do have a look at that guidance.
2 particular issues arise in relation to the guidance that Sabrina has just gone through. First of all, determining when it is or is not in a customer's interest to apply a 3-month payment deferral. And secondly, the impact of such deferrals on other obligations owed by creditors under the Consumer Credit Act 1974. As to the first issue, whether it's in a customer's interest, each of the FCA's guidance documents gives some steer as to whether that may be the case. However, they by no means provide a definitive analysis, and there are clearly no hard and fast rules. Thus, it may be difficult to know how best to proceed in circumstances where decisions are going to have to be made quickly and explained to customers in clear and unambiguous terms. Any later attempt by a firm to rely upon small print or ambiguity in the terms of the deferral is unlikely to be looked upon favourably by either the courts or the FCA. Ultimately, each matter must be considered on its own merits. However, it seems to us that the starting point should be a 3-month payment deferral, and firms should work forward from there by identifying the potential consequences of that approach and why they may give rise to issues for this particular customer. As noted, in most cases, the issue is likely to be that interest will be accruing during the deferred period. That being so, the quickest and easiest solution would be for the firm to grant the requested deferral, but to waive interest during the period. The second potential impact of the guidance is in relation to the provision of notices of sums in arrears, or NOSIAs, under Section 86B of the Consumer Credit Act. In particular, whether a quote-unquote shortfall so as to trigger the requirement to provide a NOSIA arises as the result of a payment deferral provided pursuant to this guidance. Although the issue is by no means unique in this context, the issue is a difficult one, and the analysis perhaps bears repeating. In summary, although mere forbearance does not affect a party's strict contractual rights and obligations, such that the payments remain owing during any deferred period, the creditor is plainly not expecting payment to be made from the customer. Were it to seek to enforce on the basis of non-payment during a deferral period, such a claim would no doubt be met by an estoppel defence. Indeed, given their informational purpose, sending NOSIAs to customers who are benefiting from a payment deferral period may simply confuse the situation. Against that, however, the consequences of failing to provide a NOSIA when required are significant and draconian. As a result, some firms may consider that in all the circumstances, it is better to risk giving too much rather than too little. The second set of guidance concerns high-cost short-term credit, motor finance, and rent-to-own products, and all of this guidance applies for a 3-month period from the 27th of April 2020. As with the guidance that Sabrina has covered, the key element of each document is the right to a payment deferral. Turning first to high-cost short-term credit, the guidance provides for a right for all customers to request a deferral to ease COVID-19 related payment difficulties. This should be granted by firms for at least 1 month. It's intended that it will, in effect, enable customers to skip a repayment, or in the case of payday loans, roll over the loan for a further 30 days. This period should be used by the lender productively to engage with the customer to understand the likelihood of their being able to resume payment at the end of the period. It can be requested by a customer at any point during the 3 months in which the guidance is in force, even if that means the deferral itself extends outside that period. Details of how to do so, including relevant contact details, should be prominently published on firms' websites. Unlike the other guidance, however, during the deferral period, all interest and charges must be suspended. A customer's balance should be the same at the end of the period as it was at the beginning. Further, a deferral must have no impact on the overall amount due or the calculation of cost for the purposes of the high-cost short-term total cost cap imposed by Conc 5A.2.2. The FCA notes that payment deferrals of this type will be appropriate if there has been a temporary reduction in household income. So, although not expressly stated, the implication seems to be that payment deferrals may not be appropriate for changes in other circumstances. For example, redundancy, potentially resulting in medium to long-term reductions, may require other interventions. The guidance is clear that a 1-month payment deferral is the minimum, and quote-unquote more favourable forms of assistance may be appropriate. Equally, if at the end of the month the customer is still in difficulty, further forbearance should be considered in line with firms' usual Conc 7 obligations. In granting payment deferrals, firms are relieved from the obligation to investigate a customer's circumstances. The only specific consideration is whether the period for repaying the deferred sums is one the customer can reasonably afford. In relation to reports to credit reference agencies, payment deferrals in accordance with the guidance should not be reflected on a customer's credit file. Equally, if an agreement to repay deferred sums cannot be reached because of operational difficulties on the part of the firm, no arrears should show on the customer's credit file. However, Forbearance above and beyond the requirements of the guidance should be recorded in the usual way. The second set of guidance in this tranche relates to motor finance. This applies to hire purchase, payment contract plans, conditional sale agreements, and any other debtor-creditor-supplier deal enabling the customer to purchase a vehicle. However, it doesn't apply to purchases on credit card, where the credit card guidance would apply, or to the purchase of other goods. The payment deferral proposed in this context operates in the same way as it does for credit cards and loans, i.e. a 3-month period unless it's not in the customer's interest. Here, however, where firms extend the term of the finance agreement, they must also highlight the potential knock-on consequences of doing so, for example in relation to insurance policies, MOTs and warranties. The guidance makes clear that the original agreement must not be unilaterally varied by firms in any way if to do so would cause unfairness to the customer. However, it would appear that other types of unilateral variation, subject to modifying agreement issues, may be appropriate. So, for example, in relation to a PCP, a firm may wish to increase the permitted mileage to reflect the extension to the term. Also, in the context of PCPs, if an agreement comes to an end and the customer wants to keep the vehicle but temporarily cannot afford the balloon payment, the FCA makes clear that an appropriate solution must be found. Simply refinancing the balloon payment is unlikely to be appropriate. As to enforcement, all repossession action should cease during any period of temporary payment difficulty. In any event, enforcement during the current pandemic should be conducted in light of general government guidance on social distancing and self-isolation. We now turn to the final guidance document. This gathers together a variety of what might be termed other consumer credit products, namely right to own, buy now, pay later, and pawnbroking agreements. Peer-to-peer lending, however, is expressly excluded. Once again, the key message for firms is to seek appropriate payment deferrals with customers experiencing temporary payment difficulties. Again, a 3-month period is the starting point, unless it's not in the customer's interest. For buy now, pay later agreements, that will mean a 3-month extension on the promotional period, and for pawnbroking agreements, a 3-month extension to the redemption period. Again, the exception is where it is not in the customer's interest. Since interest can continue to be charged during the deferral period, a particular issue arises in relation to rent-to-own agreements to which the costs cap under Conc 5b applies. Namely, whether a 3-month deferral might mean that that cap is exceeded. If that is the case, the guidance suggests that the deferral will not be appropriate and should not be offered. However, that doesn't mean a firm can simply do nothing. Alternative solutions must be investigated. For example, a waiver or reduction in interest, reduced payments, or a rescheduling of the term may be appropriate. As with motor finance, particular considerations also apply in relation to repossession action, or in the case of pawn agreements, exercise of the customer's right to redemption. In doing so, again, regard must be had to general guidance on social distancing and self-isolation.
So, what potential issues are created by this guidance? Aside from the issues surrounding nauseas and determining when it is or is not in a customer's interest to apply a 3-month payment deferral, issues that apply equally here as to the previous set of guidance discussed, there are a number of potential issues for firms and consumers alike created by the guidance. We're going to briefly discuss one on each side of the fence. First, in relation to firms, the limits on repossession action in the rent-to-own and motor finance guidance mean that a detailed exploration into why a payment has been missed, or why an item pawned has not been redeemed, or whether a customer needs use of the item, is required on a customer-by-customer basis before repossession action may be commenced. This will require the development potentially of new systems to ensure that firms are asking the right questions of their customers. Further, given the moratorium is to continue for as long as the guidance is in force, which is currently 3 months but which may be extended, firms have no certainty as to an end date. With assets that are likely to be depreciating, this is unfortunately an unattractive proposition. Secondly, in relation to customers, an application for a payment deferral under the Highcost short-term credit temporary guidance can only be made once, and the deferral may only be for 1 month. Thereafter, the usual forbearance rules and, more importantly, the usual reporting rules apply. Therefore, the level of real assistance that a 1-month deferral will provide customers is highly questionable, especially where payment difficulties are likely to persist for longer than 1 month. What further guidance, if any, can be expected from the FCA in relation to consumer finance? Well, as previously indicated, both sets of guidance discussed are only temporary. It is expected that they will be reviewed in the next 3 months, with revisions made if necessary. So do keep an eye out for that. Aside from that, guidance was published in relation to mortgage lenders, mortgage administrators, home purchase providers, and home purchase administrators in relation to coronavirus in late March 2020. That guidance has not been dealt with in this podcast, but is due for review in the next 2 months. So that's another thing to keep an eye out for. Other potential avenues include guidance on P2P loans and other types of regulated credit agreement, which are not specifically caught by either set of guidance. No indication on further guidance has been provided by the FCA in this regard. However, the FCA stated in their response to the motor finance guidance consultation that they will be actively reviewing in the coming weeks what further forms of support may be needed. The moral of the story is clearly watch this space. Thanks for joining us on Gough Square Live. In the spirit of keeping Gough Square Live live, both Tom and I will be available to deal with any questions arising from this podcast next Tuesday, the 5th of May, between 11 and 12. So do drop us a line at thomas.samuels@goughsq.co.uk and sabrina.goodchild@goughsq.co.uk, and we will endeavour to get back to you. Thanks for joining.